Hi, welcome to Market in a Minute. It's the Super Bowl coming up. Boy, that's going to be fun. I think we got the two best teams in the Super Bowl this year. You know, Seattle's got great receivers. Jackson Smith and Jigba. I think he's the best receiver in the NFL. And hey, he went to Ohio State, right? And then on the other side, we got New England. Their quarterback is probably the best in the NFL. I really like their quarterback. So tough pick. The nomination of Kevin Walsh, probably an easier pick than picking the Super Bowl, I think. But Kevin Walsh, solid guy. This is what he said in an op-ed, that Wall Street's liquidity is too easy and Main Street's liquidity is too tight. So we're going to walk through what that means. And then we had a number of software companies report last week, some good, some bad, and we're going to talk about how to play the group. So disclosures, this is important. Freeze your screen, please read. The market update, just to reiterate, there's 3 points that we want to make. We think volatility is going to be similar to what we saw last year. So we could have a 19 to 20% decline in the overall markets. But we think by the end of the year, it's going to be a reasonable return for investors. Expectations are high. So we're now down to roughly 14% earnings growth for the S&P 500. Was a little bit higher, but 14% earnings growth is high expectations. And then look at this. This is technology right here. Technology at 30% growth for this year in terms of earnings. So a lot of that's coming out of the semiconductor sector and the memory chip guys. But 30% growth is huge. I kind of doubt, feel really confident making this statement. We're not going to see 30% growth in tech next year. So the market's going to have to deal with these numbers being lower than what they are for 2027 and they were for 2026. So this is the third year in a row. We had 3 years in a row of double-digit returns. So this is the fourth year, and it's going to be harder to get those double-digit returns than it was probably in the prior 3 years. High valuations, high expectations, volatility. The Fed needs to be, continue to cut rates. So it's going to be a more difficult year than it was in the last 3 years. The retail/momentum investor. So this is an investor that doesn't do a whole lot of homework, and they take things higher, much higher than what the fair value is by just running to this momentum. So this is silver over here, the line going up. So you can see silver had this huge move, went to like 110, and now is corrected back down to 70, all within 1 day. A little bit higher now, but all in 1 day had a huge correction on Kevin Walsh being nominated. We think that's what did it. Gold also pulled back, and you can see here, this is the quantum computing stocks. This is IONQ. This is, I think, the barometer. This is the best company in quantum computing. Had like much better move than silver in general. And when silver took off, okay, where did that money go? It went from quantum computing and other things like that into the precious metals, or the not so precious silver, and really drove it up in a big way. So where's the silver money going to? Maybe it all disappeared with this big decline, or a big part of it. But we think maybe the quantum computing stocks, which have been decimated, maybe they pop up as a nice trade here. This is an area we want to own longer term, so we don't mind owning it here. Do it prudently. Don't take a huge position, but this might turn out to be a really nice trade. Okay, Kevin Walsh. So we think this is a good choice. We don't think he is very dovish. We think just the opposite. So of all the people that were being considered, we think he's the least dovish of all of them. And we think he's well thought out. Okay, he worked for Stanley Druckenmiller. If you don't know Stanley, you gotta look him up. Stanley's probably the brightest and one of the brightest investors out there. Sees the big picture, it can boil it down to, okay, this is how we're gonna make money. So I think probably he instilled that into Walsh, taking the big picture and boiling it down to a really simple thing and how to fix it. So taking complex issues and bringing them down to simplicity. So Warsh, as I mentioned, wrote an op-ed in the Wall Street Journal saying that liquidity was too easy on Wall Street versus being too tight on Main Street. So what do you mean by that? So interest rates were probably higher than what they should have been, but that didn't impact Wall Street, so the market continued to go up. So why did that happen? Is because the balance sheet of the Fed. The balance sheet of the Fed before the financial crisis in '08 was about $1 trillion. Then it went to 4, okay? And then with COVID, it went from roughly 3 to 3 or 4 up to 9. So you had all this liquidity put into Wall Street. Now the liquidity is being taken out maybe slowly, but it's being taken out. Maybe it's still too high. I think that's what his point is. If you bring down the balance sheet, you can lower interest rates a lot more than what the current Federal Reserve is talking about. So if you have all this liquidity, it causes inflation. And if you take the liquidity down, then you can bring rates down and allow the real economy to grow. So the death knell to the economy was the high interest rates killing off the housing market. So you got to get Main Street back in the game again. So this is going to be a tough task. It's not going to be easy. Going to have to work with the Treasury. They need to bring down the 10-year Treasury yield in combination also with lower short-term rates to get this done. It's not going to be easy. Got to think there's going to be a hiccup along the way, but longer term, that's what the Fed should be doing. The Fed made mistakes on getting too aggressive, putting too much liquidity into the economy, along with fiscal policies as well that the government did, but was too aggressive. Now they're going to have to unwind that, and hopefully rates can come way down. Earnings reports from last week. We had ServiceNow. We thought it was going to be a good report. It was a good report. Up 21% revenue growth, okay? A little bit better than what we expected. EBITDA grew by 38%. So what is EBITDA really? It's cash flow. So up 38%. That was a good quarter. So we bought a little bit. This is ServiceNow here. We bought a little bit before the quarter, way down roughly 50%. The stock got hit on the quarter, which was a good quarter. Can't imagine why someone blew this out, but they knocked it all the way down to like 113. It was about 124, maybe as high as 130 before that, and then knocked it down to about 113. We filled out our position. We like this one for the long term. What I wonder about though is if the market PE is going to contract, is ServiceNow still overvalued? When you look at it on cash flow, cash flow growth, the stock is attractive. So hopefully we're getting it at a good price. I think it's a good company. It'll grow through its problems if it continues to grow at this roughly 40%. Microsoft, they've got problems, okay? So Microsoft revenues were good, EBITDA or earnings were bad. So what's happening there is their cost of goods sold is rising much faster than revenues. So they're seeing shrinking EBITDA. So we want to see that growing. So what's exactly happening here is that they're building out their AI, and they can't offset the hit of AI through managing their income statement. So in some manner, bringing up margins in other areas. They can't quite do that. Neither can Meta. So Meta reported 24% growth, 8% growth in EBITDA. So this is better than Microsoft, which was down 9. They were up 8. Google reports Wednesday. Keep this in mind. Google is now the golden child for tech. We like Google way, long time ago, had a big move. Now it's at a level where it's probably pretty fairly valued. So if there's bad news coming out of Google, that stock's going to come down. But we think they're in all the right areas. So look at this. This is Meta, the gold line. This is Microsoft, the blue line. and then the kind of gray line is Google. So Google has crushed it. These two stocks basically have gone nowhere in a year. So they're both almost at exactly the same place for exactly the same issue. Amazon reports on Thursday. So we think Amazon's got some flexibility, like Google does, to hide some of these expenses. They've got more triggers to pull. We think Amazon will probably do okay on Thursday. So Google on Wednesday, Amazon on Thursday. We like Amazon if it gets hit for without good cause, like ServiceNow did. If it gets hit, we would like to really step into that one. Google, we think it's probably run too much. Just needs to settle down a little bit before we would really consider coming back with a big position in the stock. So what's happening in this markets? We got high valuations, high expectations, a new Fed chairman coming. We got fiscal policy kicking in. That's going to be really good. We need monetary policies to also kick in. So we need lower interest rates. Maybe liquidity comes out of the overall financial system, but rates can't come way down, and the liquidity builds naturally over time, like it should. So we think that Main Street will probably be the big winner over the next several years, while Wall Street may not be the big winner that it was. And so what would happen in the overall markets, where you're going to see that rotation continue to occur. So small caps will benefit greatly by rates coming down more than probably what's expected currently. And then you're going to see more stable companies as well pick up that have been left behind because everybody gravitated into technology. Like healthcare, probably pretty reasonable. We're seeing biotechnology stocks start to do really well. Lots of things going on there. The consumer cyclical side of the economy we think is going to be really good. At some point in time, housing is really going to kick in. The timing of this is all in question. We think you just ought to sit back and pick them off. When they come down for no reason, pick them off. But protect your money, put stop losses in, maybe even do some hedging, which is what I do. I hedge our portfolios when the market gets nasty, so we don't have big declines. So be somewhat defensive in this changing world. Hopefully that 48% in tech can moderate down in terms of its overall weighting in the S&P 500 as the other sectors come back up. So if you have any questions, come to my website, Patrick Adams CFA, ping me. Sign up for a hard copy of Market in a Minute. Come to PVG Asset Management, and you can see our strategies there. You can also ping me from there. If you have a good topic that you are concerned about, so send it to me off this video, and we'll consider really addressing that in the next several weeks. Take care.